We've all heard of investment bankers. They're the suits in the corner offices, the ones that deal with billions of dollars and make headlines when they screw up or make a massive profit. But let's be real. What do they actually do? Is it just playing with numbers all day, cutting deals with big companies? Or is it something deeper, something more strategic that shapes the financial world in ways most of us don't even understand? If you've ever been curious about investment bankers and what their daily grind looks like, you're not alone. The truth is, these people sit at the center of the financial universe. They influence global markets, impact the economies of entire nations, and make decisions that affect millions, sometimes billions of people. Yet, despite their pivotal role, most of us have no idea what their job actually entails. Today, let's dive into the world of investment banking. And by the end of this video, you'll understand exactly what these finance titans do, how they make their money, and why they matter more than you might think. Let's kick this off with some real basics. At its core, investment banking is all about two things: advising and capital raising. Sounds simple, right? But when you break it down, it's a lot more complex and a lot more powerful than just offering a little advice or lending money. Advisory services are a big part of what investment banks do. They're the consultants for corporations. They help companies make big decisions, especially around mergers, acquisitions, and restructurings. When two big companies decide to get together and form one, guess who's at the table helping make that happen? That's right, an investment banker. They're the ones analyzing the financials, negotiating the terms, and working with both sides to ensure that the deal is structured in a way that maximizes value for everyone involved. But there's a catch. Those deals are often huge, billions of dollars at stake. The complexity and risk involved means the stakes are incredibly high. One wrong move could cost a company millions or even billions. And investment bankers are the ones responsible for making sure those risks are minimized. This is where their expertise really comes into play. They understand the intricacies of the market, the financial data, and the broader economic landscape in a way that few other professionals do. One classic example of this is the merger between Disney and Pixar in 2006. This deal wasn't just a simple acquisition. It was a strategic move that shaped the entire entertainment industry. Disney's investment bankers helped structure the deal in a way that not only made financial sense, but also aligned with both companies' long-term goals. They had to navigate complex intellectual property issues, ensure that the deal wouldn't disrupt Pixar's creative culture, and deal with the potential risks of integrating two massive creative entities. The deal was worth about $7.4 billion and changed the course of both companies. But advisory isn't just about mergers. It's also about helping companies navigate restructurings, where a company might be in financial trouble and needs to reorganize its operations to stay afloat. Investment bankers step in and help them figure out how to rework their debts, sell off non-essential assets, or even spin off parts of their business to improve profitability. They're essentially financial problem solvers, helping companies get back on track. Now, on the capital raising side, investment banks help companies get the funds they need to grow. If a company wants to go public with an initial public offering, guess who's behind the scenes managing the process? An investment banker. If a company wants to issue bonds or sell equity to raise money, who do they turn to? That's right, investment bankers again. They help companies tap into capital markets, where billions of dollars can be raised in a single day. One of the biggest IPOs in recent memory was Facebook's IPO in 2012. And guess who played a major role in that? Yes, investment bankers. They helped Facebook structure the deal, price the shares, and market the IPO to investors. The deal raised $16 billion, making it one of the largest tech IPOs in history at that time. While the aftermath of Facebook's IPO didn't go perfectly, the role that investment bankers played in getting that money raised is undeniable. They shaped the financial future of one of the biggest companies in the world. So, how do investment bankers actually make their money? This is where it gets really interesting. The financial rewards for investment bankers can be astronomical. Their earnings are typically made up of fees and bonuses. For advisory work, investment banks charge hefty fees, sometimes millions or even billions of dollars, depending on the size of the deal. And on top of that, bankers often earn a bonus based on the success of the deal. If they helped a company raise a huge amount of capital or brokered a multi-billion-dollar merger, they can walk away with millions in bonuses. But it's not just about big deals. These guys live in a world where risk is their bread and butter. If you think about it, the financial markets are unpredictable. Stock prices rise and fall. The economy can take a dive, and investors can panic. Investment bankers have to stay ahead of the curve, anticipating market shifts and trends before they even happen. One mistake can cost them and their clients dearly. Let's not forget about proprietary trading. In the past, many investment banks engaged in proprietary trading, where they used their own money to trade stocks, bonds, and other financial products. While this has been reduced in recent years, some investment banks still engage in this practice, and it can generate huge profits. They're essentially betting on the market, using their expertise to make profitable trades. This was the core of the infamous Goldman Sachs trading desk during the financial crisis of 2008. They were taking huge risks, making massive profits, but also risking everything. Investment banking isn't without its controversy, though. If you follow the news, you'll know that investment banks often find themselves at the center of scandal. They're criticized for creating speculative bubbles, exacerbating income inequality, and profiting off the suffering of others. The 2008 financial crisis is a prime example of this. Investment banks, including Lehman Brothers, Goldman Sachs, and others, were heavily involved in the subprime mortgage market. They packaged risky mortgages into investment products that were sold to unsuspecting investors. When the housing market collapsed, it sent shockwaves through the global economy, and investment banks were at the center of the storm. But despite this, investment banks continue to thrive. They're deeply embedded in the global economy and continue to have a massive influence on markets, governments, and the business world as a whole. The entire structure of the global financial system depends on their ability to make big moves, secure capital, and advise clients on the best possible paths to success. So, who actually works in investment banking? Investment banking isn't your average 9 to 5 job. It's a world where long hours, high stress, and intense competition are the norm. To even get your foot in the door, you need an elite background, often from top-tier universities and business schools. The majority of investment bankers come from schools like Harvard, Wharton, or Stanford. From there, they typically start as analysts, working insane hours just to prove their worth. Over time, they can move up to associates, vice presidents, and eventually to directors and managing directors. The top dogs who make the big deals happen. But the career path isn't for everyone. It's grueling, it's competitive, and for many, it leads to burnout. However, for those who thrive in the high-pressure environment, investment banking can lead to a very lucrative career. Many investment bankers leave to start their own hedge funds, venture funds, or private equity firms. Some even end up in government or academia, using their financial knowledge to shape policy or teach the next generation of financial professionals. The future of investment banking. As we look to the future, the role of investment banking is evolving. With the rise of Fintech and cryptocurrencies, traditional investment banking is facing competition from a new breed of startups offering fast, decentralized financial services. The growth of robotic trading algorithms, blockchain technology, and peer-to-peer lending means that the business model of investment banks could be under threat. However, despite these challenges, investment banks remain deeply embedded in the financial system. They have the expertise, the capital, and the relationships to continue dominating the markets. But the future might look a little different. Traditional investment banks could either adapt or face serious disruption from newer, tech-driven financial services.